Hello, everyone. Welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Kroger because they had earnings this morning, and the market sold the stock. It was down nearly 3% at its lowest. Now it's only down 2.6%. But I've looked through the earnings, and honestly, not too bad. So this might be a little bit of a buy opportunity. I have the lines here for what we looked at the last time. Go back and watch that video for a little bit of background on Kroger. We're not going to go too depth into the historical numbers. We're going to look mostly at the earnings today. But we can see around the $45 mark would be a decent value as of the current fundamentals of the stock. Its fair value would be at 54, and then overvalued would be 61 and above. And we see that for a little bit leading up to these earnings, it was trading in value range. And that's why I had given it a buy, because it's down. If for a value investor, it's down at the buy levels. Even today, it's almost to 46, so it's a little elevated, but there's still a rather large margin of safety, and the value is clearly there for the stock. When it had run up, it had run all the way up to the sale price, and then that was basically the cap. But we'll take a look at the numbers to get an idea of what is going on there, but not look too closely on them. We can see that at the end of last year, a fair value would have been $48.50, which would have set a buy at 41.25. The main driver was the earnings, followed by the dividend, balance sheet, and then cash flows. And the expectations for this year, if they're able to come on trend or hit forecasts, we'd see even more coming from earnings, even more from cash flow, more from the dividend, but there is a bit of a drop in the balance sheet. We'd be looking at a fair value of nearly $58.50, and that would give us a buy of a little over 49.5, sell around 64.5. And that's how I came up with those numbers that we saw on the chart. It's kind of a midpoint between the end of last year and the expectations for the end of this year. Continuing forward, we'd be seeing a fair value in the 60s, which would be a buy in the 50s and a sell in the high 60s. So the trends for this company look good. They're a little low on revenue growth. This year, they're only expecting about 2.5, from what I've seen in their guidance. Cost of goods have been climbing on them. Their expenses as a portion of their revenue shrinking, but pretty stable around 97. Very low margin business. It's groceries. Their earnings have been growing at a great rate, 27.5% year over year. They're buying back shares. They're raising their dividend. So as a shareholder, there are some good things that we're looking at. For the earnings yield, what Benjamin Graham would have looked at, this would definitely be a buy, 9.2. What Peter Lynch would have looked at, the growth in the dividend, the growth in the earnings, and the current PE ratio, you'd say it's very undervalued, coming up with a 7, where a 1 would be fair value. We see historically it trades for around $14 or 14 PE. Right now it's at 10. So just on a market basis, it's a little low. And we can now take a look at those earnings and see, why is the market selling off? And I think the main driver for that sell-off is the Albertsons merger being called into question. Because part of my thesis for this stock is, if they're able to follow through with the proposal for the merger with Albertsons, they knock out a competitor. All of a sudden, they move from 31 states to 50 states, and their revenue per store is significantly higher than what Albertsons is. So if they can start bringing a similar model to those stores, their revenues could more than double, potentially triple over the next few years. And in these earnings, they don't say a whole lot about it. I read through the 4 mentions that they have, and they just say that a risk factor is the merger not happening. So let's see how the stock is doing. Identical sales without fuel, up 3.5%. Underlying growth of 5%, that's great. I mean, a little low, but still growth when we're looking at some of these other stocks is not happening. Operating profit of 1,470 million, adjusted FIFO profit of 1,669 million, earnings per share of $1.32, adjusted EPS of $1.51. They grew their digital sales by 15%. They saw more households and trips coming through the store. The CFO gives a little summary of results here. Sales declined from last year. I mean, they're up 3.5%, but there was a 4.1% growth this last year. Earnings per share, we already touched on last year. It was only 90 cents in this. Operating profit was a little bit lower. Gross margins increased by 21 basis points. That's good. Gross margins were 22.3%. Now we can take a look at how they've historically performed. And we see gross margin percentage, 21.4 is what they came in last year. 2020, they had 23.3. That was the highest that we've seen. So it's up from the last 2 years, but it's not a high for the time frame that we're looking at. But that's something good for the stock. Having higher margins, more cash is going to flow down to the bottom line, and it'll help them pay down some debt, buy back some shares, raise their dividend. Debt to adjusted EBITDA ratio is 1.34 compared to 1.68 a year ago. And here's the full year guidance. So they're expecting sales to be up 1 to 2%. I had factored in 2% in our sheet. Underlying growth of 2.5 to 3.5 after adjusting for the effects of Express Scripts. Adjusted net earnings of 445 to 460. And in our sheet, we were looking at what analysts were expecting. Now, analysts are only expecting 450, so they're on the lower end of that range. If we bump this up to 460, the high end of the range that they've given for their expectations, we see that there's a bit of a jump in the value of the stock. It jumps up to 50.15 for the buy. And we'd hope that there'd be more growth the following year, because that puts them above what analysts are expecting for 2024. Effective tax rate of 23%, capital expenditures of 3.4 to 3.6 billion, a free cash flow of 2.5 to 2.7 billion dollars. So that free cash flow is higher than what I have here, which would have been their traditional free cash flow yield. So their free cash flow as a proportion of their revenue is getting eaten away a little bit. With 2.5 to 2.7, we'd be looking at a bit of a decline there. I mean, it's up from last year, more than twice what they came in last year. But how they've historically performed, there's a bit of a decline there. Nothing too major. I mean, we are hoping for a merger or acquisition of some sort. So that would take a lot of cash. Here we have the numbers. So sales of 45,165, which after everything is taken out, they end up with an operating profit of 1,470 compared to the 1,505 last year. Interest expenses are down, so they have been either working on their debt or getting better rates on them. Pension plan down a little bit. Loss on investments significantly less than what it was last year. Tax expenses way more than last year, almost double. Net earnings up nearly 30% from last year, 666 to 962. Balance sheet. This is one that I really want to look at. So their assets have moved up a lot from 12.3 to 13.2 for their current assets. Total assets are up from 49 to 50.2. So that's very good. Liabilities moved from 16.2 to 17.1. Other long-term total liabilities down from 39.7 to 39.3. So that's trending in the right direction. Actually, that breaks the trend that we had seen previously, where their liabilities were climbing on them. We see that year over year was climbing about 2.6%. They started in 2019 with 36.5 and had worked its way up to 39.5. Shareholders' equity is up from 9.4 to 10.8. That's a massive jump. That's very good to see. Common shares outstanding, so they bought back 2. Diluted shares year to date, so they bought back 9. Okay, cash flows. We see that their cash flows were up more than double what they were last year. They were negative on their inventories last year, positive this year. That's one of the major differences here. Receivables was negligible this last year, 274 this year. Trade accounts payable was cut in nearly half. Accrued expenses down 300. Income tax receivable and payable was negative this last year, positive this year. Just a few things to note. Cash provided by investing activities, so they're spending their money on investments. Net cash used by financing activities, they used less than a quarter, or around a quarter of what they did this last year. Net increase in cash, a pretty big increase. They had spent quite a bit this last year. So honestly, this is not a bad earnings report. It's just the market was expecting more growth than just 1 to 2%. And in the inflationary environment that we're in, the consumer is buying cheaper products. In part, that is the house brand stuff, the stuff that Kroger has higher margins on. That's why we see the margins jumping. But the sales just aren't growing the same way because they're selling cheaper stuff. So, I think that the market is wrong for the sell-off. They're holding their guidance, expecting things to be fine. I like that the margins improved. I like that they're paid down debt. So, in fact, I came into this earnings saying they're at a fair value. I want to buy. And now I think that they're an even better buy. At the current price, with those fundamentals that they're coming out with from this earnings, they're definitely a very solid value play that is going to pay out potentially in a pretty short time frame. We had seen it jumping up to the sell back in early 2022. And it had started that run up to that point right around the same price level that it is. It moved straight within just a few days from buy to fair value, and then took a little bit of time, worked its way all the way up to the sell, and has been kind of on the decline since then. But that's what I'm seeing with the stock. I like the values. I like the price. I'm going to go buy more. So hopefully you guys enjoyed it. Like the video if you're going to be buying more too, or if you just enjoyed looking over the earnings together. Let me know if there's any other stocks with earnings coming up you want to take a look at. And make sure you subscribe so that way you can catch all of it. Thank you guys for watching. I'll catch you next time.